Good afternoon and welcome this afternoon to Trading Covered Calls and Cash Secured Puts. Another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. And I'm joined out there in the chat by my good friend Brent Moores, who is a great educator, 20-plus year veteran of the financial market, and has taught this webcast on a number of occasions. So I'm glad to have him out there in the chat helping to answer your questions. And I'm especially grateful to have all of you here with us, whether you're here in the live version today or in the recorded version. It doesn't matter. Participate in the chat. Make sure that you're a part of the conversation. Leave a question or a comment for us in the description page in the comment section if you're watching in the recorded version. And, you know, we're at that point now where we're kind of at the tail end of our earnings season, very, very kind of last dregs of earnings. And so there's still a little bit of volatility coming in. We've got geopolitical news going on, so volatility generally relatively low, and it's been going down today, which is kind of interesting as the market has been moving around. It popped up a little bit, it's popped back down. And so I want to talk a little bit about taking an opportunity as you look at individual stock positions to make a decision about, do you sell a covered call? Do you sell a buy right strategy, or do you use a cash secured put? So we'll talk through that process. We'll also talk about the idea of using probability of touching in this discussion as well today. So as we get into this discussion, a couple quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy. Also remember that options carry high level of risks, are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options and before you consider any option, strategy, or transaction. Remember also, of course, that when you're short an option, there's a potential that you could be assigned early on that option. We'll talk about those possibilities or probabilities as we get into this discussion as well. Remember also that when you create multiple leg option strategies, those may involve multiple transaction costs. And remember that spread trading must be done in most cases in a margin account. So let's talk a little bit about a couple of other things. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. It's not a guarantee of future success. It is, however, a great learning environment. Also, remember that some of the things that can happen in a live trading account will not happen in a paper money account. Specifically, that early assignment of short options. So as you move your practice from paper trading to live trading, be aware of that difference as we get into it. And of course, remember that there is risk involved in the market, regardless of the financial instrument that we choose to look at. Investing involves risk, including the loss of principal. So let's talk a little bit about what's going on in the market. And I wanted to kind of take a look at this first one really quickly. So right out of the gate, I wanted to jump into a particular trade here. So I wanted to come in here to FedEx. This is one of the last earnings announcements to come in this Q2 tranche. And so as we kind of get into this mix, we've got a little bit of elevated volatility. One of the very few names that has elevated volatility at the moment. This is FedEx. It's been in a somewhat downward moving trend. It's been moving to the upside today on the overall market, kind of being up and down. FedEx is up a little bit ahead of the earnings announcement to the tune of about 1.33%. So the thought was here, with that elevated implied volatility, with the earnings announcement kind of on the horizon, on the very, very near horizon, in fact, after market close today, the thought was, because this has a little bit of elevated implied volatility, to take advantage of that elevated implied volatility with the expectation that the general overall trend in the intermediate term has been up, despite the fact that it's been an overall downtrend. It seems to be breaking. If we were to draw a line of resistance, it seems to be breaking and holding that breakout of that resistance level, maybe squeezing into a little bit of a symmetrical triangle, but some upward movement today. So my thought here was, this may be, given the technical perspective, a situation where this could be an example of a cash secured put. Yes, and indeed, certainly some sad news for the FedEx family as well. But taking a look at, again, not capitalizing on that particular perspective from an overall generally bullish perspective, and being willing, perhaps in this case, that's one of the questions that we have to ask as a cash secured put seller. Are we really, truly, honestly willing to buy this stock? And if that's answer is positive, then yes, we're willing to buy it. Then a cash secured put might be a perspective that we could take here in this particular case. So what I'm happening to notice from a support level standpoint is we've got a bit of a support right here at about the 220 mark, kind of the confluence of that uptrending support level. It's also the confluence of that downward trending diagonal trend line. Perhaps it's also right about this horizontal as well. So you kind of have this three-way confluence of support right here at about the 220 mark. That by no means guarantees that the price of the stock won't go down on some kind of adverse information in the earnings announcement. But at the same time, that suggests that that might be a point at which buyers are willing, because they've been willing over the course of the last week, to step in at that level. So because there may be buyers willing to step in at that level, that might be an area where we could anchor our cash secured put idea around, right? So as we start to look at where that area is, right around that 219 or 220 mark, I'm going to use that as our support to determine where that level might be. Let's see if we can get that audio working a little bit better here. All right, stand by, guys. We'll see if we can get the audio working better. I'm going to turn my video off for just a minute and see if that will kick that stream. We'll kick that stream back into high gear here and see. Looking on my end. Yep. Okay. Cool. All right. So we'll see. Yeah, our producers are working on that on our side to see if we can resolve that that issue. But nevertheless, all right, sounds better now. It sounds like. Okay, so now what we're going to look at is we're going to go to the trade tab here for FedEx. And one of the questions that we have to ask is, over what time period are we willing to put in this cash secured put to have that opportunity, but more importantly, have the obligation to take delivery of the shares of stock? Over what period of time are we willing to do that? And so what I'm going to do is I'm going to look to kind of, again, this elevated implied volatility as kind of a guide from that standpoint. Not a rule of thumb, not a guarantee, not in any way case a recommendation, just simply an idea that might lead me to thinking about selling premium, because that's what this is, a cash secured put, in this particular case being a premium selling strategy. So I'm going to look out here 10 days to go until expiration. That's got still a fairly elevated amount of implied volatility. And Greg, yeah, I mean, if 4 days till expiration, short put vertical would also capitalize on that high implied volatility. But we still have 63% implied volatility currently in that July 3rd expiration. It's also a holiday shortened week. It's also tends to be a fairly low volume traded week because traders take summer vacations. So there is the possibility of adverse movement. That may also be one of the reasons why implied volatility is a little bit elevated there still. So the implied or kind of the expected move here in this particular case is down about $19 or up about $19. Well, we're currently sitting at about 227. So if we were to just do that, and we were to just take our calculator here and do 227 minus, we'll just take it and 19, that's going to put us right around 208. So if we were going to round that a little bit, we might be looking for a 210 or a 205 strike somewhere in that area to be both below that confluence of support as well as kind of right on the edge of that expected move. So I'm going to go out to the 3rd July expiration. We're going to open that up. I probably don't need 100 strike prices like I do when I'm looking at an index, but I'm going to come down here and I'm going to say, look, I've got a strike price at the 205 strike. I've got a strike price, in fact, at the 207.5, which is going to get pretty close to that expected move, right? Now, so CS saying, well, FedEx has low volume. So FedEx is trading today ahead of the earnings announcement at about 902,000 shares. So pretty close to 1 million shares. If we round that up, that's pretty close to 1 million shares being traded. If we wanted to open this up and take a look at volume and open interest, we could do that certainly as well. And we could say, look, if we're selling one contract or two contracts against a strike price that has 172 contracts traded today and 217 contracts traded in open interest, open and unexercised contracts, that's not an illiquid contract. In fact, if we look at the bid-ask spread in conjunction with that, right, at the 203, so 203 bid by 216, that's a fairly narrow bid-ask spread for a $200 stock. So it's that's 13 cents, right? So I don't ascribe a particular percentage. I don't look at those ideas. I mean, I look to see, is there open interest primarily? Is there a narrow bid-ask spread? And is there some sort of disparity? Because I start to look at some of these other strike prices. So look at the 202 half and the 207 half. Those both have a pretty wide bid-ask spread. In fact, the 202 half has, even though it has some open interest here, has a big, wide, almost dollar-wide bid-ask spread there, right? Okay. So that's kind of going to be my general level of expectation here, what I'm going to be looking for in this particular case. So we're going to look at selling this 205 strike. And so that 205 strike, bringing in $2, and we'll say kind of right in the middle there, $2.08 roughly at the mark price. That is, again, we look at this from the standpoint of the kind of probability of success, number one, and number two, the amount of return that we're getting. That's still a fairly elevated amount of return, given the fact that that implied volatility is relatively high. And we're kind of on that outer edge of that probability range in which the price of the stock is likely to be. So one of the things I want to do here in terms of this discussion is I want to kind of create a custom column set here. I don't want to look at volume and open interest, so I'm going to take those out. But I want to create a custom column set of the things that would be beneficial for me to know in putting together this cash secured put. So the first thing that I might look for is delta. Delta, right? So delta is that likelihood of, well, first of all, foremost, it is an expression of the rate of change of the option premium to a move in the underlying stock. So we know that if the price of the stock goes up, that's going to take away from the value of this option, which is exactly what we want to have happen, right? Now, the next thing I want to add into this mix is theta, because I want to know what the impact of time is going to be on this trade. But I also know this, that I've got 10 days to go until this option expires. So it's not, I know that theta is generally going to be elevated a little bit. That's a consideration. I want to see what that rate of theta is, although I'm not really all that concerned about it, because I know that I want this time to eat away. I know this is a fairly out of the money option, so a fair amount of that time decay is going to come in the first week or so of the time from the time at which we sell that option. The next thing that I want to look at is Vega, and that is the sensitivity of this option premium to changes in implied volatility. So once the earnings announcement is released, implied volatility is likely to go down. That's going to benefit this trade for me as the seller of a cash secured put, right? So the last thing I'm going to put into this mix is going to be probability of touching. Now, probability of touching differs from probability of out of the money or probability in the money. We can use probability in the money, probability out of the money. That assumes taking this all the way to expiration. Probability of touching says, what's the likelihood of this price getting to that level at any time within the remaining lifespan of this particular option? And what we can do from using that probability of touching, it's almost as if it is a probability of out of the money, but detuned a little bit, right? Because it says that this could happen at any particular time, and not that we would be assigned as soon as that price hits that short strike, if it does. But the likelihood of this showing up and touching that level that we're selling is going to be beneficial for me to know, because it's going to tell me the probability of the outcome in this trade. Now, I may not hold this trade all the way through expiration, meaning I may buy this back and then move on and eliminate the obligation prior to expiration. So that's the other reason why I'm using probability of touching in this particular case. So I'm going to save this as delta theta vega probability of touching, and I'm just going to put it like this: CSP, cash secured put / covered call. And I'm going to click on save. Now I can go back to that one whenever I want to, and now I've got that layout. So here's what I know. This is a fairly low probability trade, or excuse me, fairly high probability trade, 15-cent delta, which means if we just look at it objectively from that probability of out of the money perspective, this has about a 15% probability of being in the money at expiration, and it has about a, 85% probability of being out of the money at expiration, right? About 15 delta. Theta is going to be working on this to the tune of about 29 cents a day of taking away that extrinsic value. Volatility, one of the things we know is that sensitivity to Vega gets smaller as we move closer to expiration. So if implied volatility doesn't fall that much, it's not going to work that much, not going to work that hard on my option premium. That's okay, because Theta is working hard on that option premium to the tune of plus 20 cents above that 9 cents of Vega, if that makes sense, right? So 29 cents of Theta working inevitably versus a 9-cent impact if implied volatility does fall, which we don't know for sure that it is going to do. It's likely to, but that's not a guarantee, okay? And then we have probability of touching. The likelihood of the price of this stock moving down to 205. Now, we also kind of put it in this range right here using implied volatility. We said $19 move to the downside or to the upside is the expected move based on implied volatility. This is consistent with that, right? A 34% probability kind of falls right about that one standard deviation range, right? So the likelihood of this happening, the likelihood of this getting to that level of support, that 205 level, where we're selling this short strike, is about 1/3 versus 2/3 probability that it's not going to do that. Now, human nature tells us that we underweight the likelihood of those scenarios happening, right? On the other hand, we also underweight the likelihood of a high probability scenario happening because we kind of anchor to the fact that, hey, this is an earnings announcement, there's potential for big news movement, but this is what the numbers are telling us, right? This is what this implied volatility number is telling us, that this is what the collective expectation is of the options market, which is generally pretty close. Also, we also know that this number and that implied volatility number tends to overprice movement, meaning it gives us more movement generally than expected because of kind of that natural human nature to be optimistic on both sides of the equation, right? Both to the upside and to the downside. So that tends to overprice. This expected move tends to get overpriced, and the other numbers tend to get underpriced or underexpected a little bit here from a psychological standpoint. So we've got a fairly highly probable trade here in this particular case. And what we've done is we've created some metrics that we can use to kind of help us assess that, right? Including probability of touching. So probability of touching says we've got about a 34% probability of coming down to 205. We know that that's probably not going to happen right away, right? And we also know that we're not likely to be assigned, like I said, at the immediate point at which it touches 205, unless we're extremely close to expiration. And so one of the things we might be thinking about is closing this trade down prior to expiration if it does what we expect it to do. And as I've been talking, you notice that the spread has gotten a little bit wider, and implied volatility has already started to come down. So I've already talked through some of the premium that I could have gained in the trade. So I'm just going to go ahead and we're going to put this trade in. I'm going to read through this order, click on confirm and send, read through this order. I'm going to put this in my cash secured puts and covered calls group. So I'm bringing in $1.98 to wait for the opportunity to buy the stock at 203, essentially. Am I okay buying the stock at 203? Yeah, I was okay buying it at 220. I was okay buying it at 205. Buying it at 203, which is the discount, essentially, if you think about it from that standpoint, the discount of where we would buy the stock at the 205 strike minus the premium we're bringing in, that's okay, right? So we've got to hold in our account. Again, this is going to be capital intensive. We got to hold in our account $20,302. But if we were going to buy the stock, we'd have to be spending that money anyway, right? So you'd have to have that cash in order to be able to buy the stock anyway, in order to put this trade on. So that's not, it is a concern, and it is something to be considered, because this is not an inexpensive way to enter a position here, right? But at the same time, it is a way that we can get into the position potentially, if it's put to us, for a little bit of a discount. Now, if we don't get the stock put to us, or we close the trade down prior to expiration because it's gone up, then there is the possibility that we could do this again, right? And generate a little bit more premium. All right, so here's what we're going to do. I'm going to go ahead and click on send. We're going to fire that order off, and we sold it for 205. So we got 205. That's not bad against where it was currently. So that's about where we were thinking. Cool. We got the 205 for 205. I like that. And so now the expectation is, as we look at the chart, price of the stock continues to move higher. That's going to decrease the value of that premium. If implied volatility goes down post the earnings announcement, which normally is what happens, then that works in our favor. If time passes, then that works in our favor as well, for the potential of either buying this option back, and we go back to the monitor tab into our cash secured puts, and there it is right there, cash secured puts. It's already starting to work for us to the tune of what, 12 cents here already. So that's or actually 26 cents. So that's working in our favor already in this particular case. So the idea being, we could buy this option back and eliminate the obligation if we needed to. All right, so that's cash secured put on that side of the equation, using probability of touching as a metric. So thinking about where that 30% probability of touching puts us, that's about that 2/3, 1/3 perspective of likelihood of the price of the stock getting to that level. So the next thing I want to do is I want to kind of look at a couple of scenarios here where we might sell a covered call. So for instance, Coinbase. And let's go ahead and talk about Coinbase here on the other side of this coin. I didn't do that on purpose. Okay, notice what Coinbase has done. I've in this particular account, in this demonstration account, I own shares of Coinbase. Coinbase is kind of running into this resistance level here, right? And so it's kind of bouncing a little bit. It's kind of sitting right here at about the 301. It's currently at 305. So one of the things we might think about is, again, at this opportunity, if this starts to pull back a little bit, harvesting a little bit of this elevated implied volatility. What's interesting is that the implied volatility went up as the price of the stock went up. And that's not a usual scenario. All right. Usually, if the price of the stock goes up, implied volatility goes down. So I want to kind of capitalize on that tendency for implied volatility to be mean reverting, right? And kind of come back down, even though we don't have an earnings announcement necessarily as a potential catalyst. So we've got another resistance level up here at around 344. I would argue that we probably have another level of resistance up here right around the 320 mark, where the price of the stock has been before. So there's 320. So I'm going to start looking right around that 320 mark. So I'm going to go out to the trade tab for Coinbase, and I'm going to look at where I can still take advantage of some of that elevated implied volatility. Now, I just bought these shares of Coinbase earlier today as a demonstration. So what I might look at doing here in this particular case is selling, because look at the elevation implied volatility, right? In this 4 days to go until expiration. So can I sell a covered call with 4 days to go until expiration? Yeah, the balance here in this particular case, as the balance always is in selling a covered call or in selling premium, is we are balancing the amount of time that we're in the trade versus the amount of premium that we're bringing in. The less time we're in the trade, it's very likely the lower amount of premium that we're going to bring in, right? So the other side of this equation that's maybe holding this up is the probability of success of the trade, right? So if we've got a highly probable trade, meaning we're using what we just talked about, using probability of touching, using delta as a means to kind of select a strike price, including implied volatility and expected move, then we might be okay with that smaller amount of premium. But with elevated implied volatility like this is right here, that might offset that, might give us more of an opportunity. And not that I'm suggesting that more often is better, because you don't have to trade 4 DTE covered calls by any means. But that might give us another opportunity to do that again a couple more times with still some elevated implied volatility. Now, hopefully implied volatility goes down. It doesn't always, but our expectation here is in this particular case. So we take a look at where we were. 320 is where we're going to look as a starting point. So let's go back to our trade tab and let's see where the price of the stock is. It's at 306. So if we think about where that plus minus is, that's also about $20 plus or minus given the current level of implied volatility. So that is what? To the upside. Now, the price of the stock is currently sitting at 306, so that's at 326, right? 326. So we might sell that far out to the 325 strike. And you notice that that has a 42% probability of touching. Higher implied volatility means greater potential for movement, right? Greater potential for movement. That's why that probability of touching is a little bit higher there, right? Vega is a little more sensitive. Look at the time decay with 4 days left to go. 92 cents, 91 cents. So we know that in 4 days, all of that extrinsic value is going to be gone. Again, I'm going to just cross-check against this with my volume and open interest. And so I'm going to look out here right around that 325 strike. And I've got tons of volume and open interest. Not that that guarantees anything. Not that that guarantees that that bid-ask spread is going to be small. Not that that guarantees a good, reasonable fill price. But it suggests that that's a liquid area in the market, that 325 level. So if that's the case, there's also the argument, and some will argue, that when you see these high levels of volume and open interest, that has some gravitational pull of its own, right? That tends to pull the stock to that level or push the stock down to that level because of the tendency for option market makers to buy or sell stock to offset their risk in the market. So there is something to that, but I'm not 100% convinced that that is enough of an influence for us to disregard that strike price. Given the fact that it's got a tight bid-ask spread, 9 cents here, 11 cents in this case, 10 cents. Now, that's where I'm going to kind of concentrate my effort. And I'm going to change my layout once again to delta, gamma, or delta, theta, vega, right? And so we're going to come in here to the 325 strike, and we're going to look at selling that call option against that 325 strike. Now, once again, this is also a stock where we have to kind of say at the outset, are we really truly okay giving up the stock and selling it? So if I can sell the stock, I bought it at 302, and it's currently trading at 305. And if I could sell it for 325 and bring in $3 of premium, am I okay with that? Yes, right? Yes, I am. And that's the question that we have to answer. That's the affirmative that we have to tell ourselves in that particular case to make this trade, from a selection standpoint of the stock that we're selling a covered call against, to make that make sense. So while this is not technically a buy right, meaning you buy the stock and sell the covered call at the same time, same kind of concept. My expectation is here that I may very well be called out. And if I'm called out, if we go back to the chart, if I'm called out at 325, That's right up here, right around a resistance level where the price of the stock might bounce down again from that level. Am I okay with that? Sure. Because then where might it come back down to? 302, where I might sell a cash secured put to then take possession of the stock and then do it all over again. No guarantees there, and that adds some complexity to the mix for sure. But I'm going to come over here to the 325 strike, and we're going to click on the bid price there. We're going to read through this order, make sure that this is what we want it to do. We're going to bring in 305 against infinite maximum loss, but it's not really infinite maximum loss because we already own the shares of the stock to deliver against the obligation. I'm just going to make sure that it's in the right group here, which is cash secured puts and covered calls. Probability of touching is a little bit higher here, but that's to be expected with that higher implied volatility. And I'm okay with that higher probability of touching in the event that the price of the stock moves up. I'm okay being called out, right? I'm okay being called out. So I'm going to go ahead and I'm going to click on send. We're going to fire that order off. It filled for 305. Now, you notice this delta is a little bit higher as well. Higher probability of touching generally is going to lead to a higher delta. You're going to have a higher probability of touching at a higher delta, unless you go deeper in the other side of the equation, right? Because then that probability of touching starts to fall off again, right? 23 delta. So this again supports that idea. One standard deviation, maybe a little bit more than one standard deviation. One standard deviation often falls right between this 20 and 30 delta range. So we're right about that one standard deviation area where the price of the stock is expected to move to. And if it does, and we get called out, great, we just turn around and do it again, theoretically. Assuming that there's a liquid market, there's no guarantee of that. Assuming that we could accomplish that, assuming that the conditions are right, assuming that our bias is still the same, which is in this case bullish, but we're selling a covered call against this premium. So let's go back over here to our monitor tab and let's take a look at that position right here. That's Coinbase. And so now here we have 4 days to go until expiration, an option that was trading at 305. Now it's gone up a little bit because the price of the stock's gone up just a little bit here. But we own the stock at 296. And if we were to buy the stock at 296 and sell it at 325, are we okay with that? For sure. Yeah. So yeah, pretty close to the one standard deviation to the downside in this particular case would be that 217 range. It's currently trading at 305. So remember, one standard deviation plus or minus here in this particular case. So one of the ways that we can do that, we can go to the chart, and we've done this before. So if you're with me in the index options, in the index options webcast on Wednesdays, one of the grids that we use, and I'll show you what that grid looks like, and I'll even share it out here in this group, is this one right here, our index options grid. And what I have on here, if we were to put on here coin, right, we have the probability of expiring curve or cone. That's a technical study that shows kind of that, yes, it shows probability of expiring, but it gives us that one standard deviation. So if we take a look here at the characteristics of this particular study, that probability range is 68%. 68% represents that one standard deviation line. So what we can do is we can take our cursor vertically here, right? So I'm going to come across here and I'm going to say, look, our expiration is on the 27th. Where is our crossover between that line? And so that puts that one standard deviation range up there around 328 or so at expiration, right? Taking that all the way to expiration. Probability of touching is going to be a little bit higher than that because there's the potential that it could move pretty quickly. So 330 on that side is 330. So we're kind of pretty close to that. We're within that one standard deviation line. It could move a little bit further, but if it does, you know what? Okay, we get called out. But again, that goes back to my expectation that if we look at the trade tab here, this number, that implied volatility expected move number, tends to overprice movement, right? It tends to overprice that expected move. So if implied volatility goes down, then what's going to happen to that one standard deviation line? It's going to shrink, right? So now, Mike, here's the thing I know, and I'm glad you asked that question, right? I sold at the bid price because I'm doing this in paper money. Even this is, even though this looks like a live trading account, this is a demonstration account. It is built on the base of paper money, so it feels like paper money. Let me say that again, because if you're in Utah, I just said feel, but I said it with a Utah accent. It fills orders like a paper money account, meaning it fills at the midpoint, right? So I can work the order, and you can certainly, to Brent's comments here, you can work that order to create a little bit better theoretical fill price. So if I create this order, I can try to work this towards that midpoint. But to Brent's point, it may decrease the likelihood of that order getting filled. And that's something to keep in mind, right? So work the order, but sometimes it's like the search for the perfect sometimes outweighs the likelihood of getting the good, right? So if we're trying to find that midpoint, trying to get filled at that midpoint, we might miss the trade entirely, right? And we might miss the opportunity to get in the trade. So just something to consider. In your trading, do what you would like to do. Try it both ways and see what works for you. Also, one of the benefits of trading a liquid stock. So Coinbase is trading 14 million shares today. I mean, we're talking about a strike price, right? When we were looking at volume and open interest here of about 14,000 contracts in open interest. So this is a very liquid strike price. So working the order probably might help us out a little bit. Whereas it would in the FedEx trade, probably not so much, right? So keep that in mind in that particular case. So now we've got an example of using probability of touch and expected move as a means to help us determine where to select a strike price for this covered call. 4 days to go until expiration. Once that trade either goes out worthless or we buy it back, and then we can turn around and we can sell that premium again, assuming that our directional bias is still the same, assuming that the expectation for what we want it to do is still moving in that direction, still doing what we expect it to do. All right, so now the next thing that we might look at here in this particular case, in putting this trade together or putting a trade together, is another scenario here. I'm going to go back to my monitor tab. There's our Coinbase trade, and I've got a couple of others in here. And one of the questions that I have is, we take a look at a stock like GE. So this is a stock that has been moving considerably higher, and I've got shares that kind of have a base price, a purchase price of about $65 a share. The stock has gone up significantly since buying those shares, right? And this is one of those questions, again, right? This would represent some pretty considerable gains in the trade. So selling a covered call against shares like this may be something that's done with some careful consideration, because the possibility of having those shares called away could trigger a taxable event. So I'm not a tax advisor. We don't give tax advice. I don't even play one on TV. But that's something to consider in making that decision about selling a covered call against a position like this, against shares like this. Now, one of the things to think about is you don't have to sell. I've got 500 shares. You don't have to sell a covered call against all 500 shares. You don't have to sell 5 contracts of the covered call against all 500 shares. We could cover some of those shares. So let's take a look at the chart here really quickly. Let's go to GE. And you can see what GE has been doing. And the reason that I was looking at this is implied volatility is not very elevated. The momentum has been to the downside, but it's made kind of this nice little bull flag type run. So my thought was, well, cool. If I were going to set a level at which I would sell that covered call, I might look to sell a covered call up at the top of this bull flag and expect that it maybe comes back to that level, depending on what I expect this to do. I might even go a little bit further out, maybe out to, and again, depending on the length of time that we were looking at being in this trade, where that one standard deviation is. But if my expectation is to hold on to the shares of the stock and just simply collect some premium, then I might be willing to accept a little bit less premium for a little more headroom for the stock to move. So we're going to go to the trade tab here, and we're going to take a look at this trade. So once again, I'm going to look for where there might be some elevated implied volatility. If I were to go out to the 32 days to go until expiration, the 25 July, I'm pretty sure that by looking at the chart, I'm going to verify that that level, that 32 days to go until expiration, the 25 July expiration, with elevated implied volatility, is also probably the next earnings announcement, right? The next earnings announcement. So if we go out to that chart really quick, there it is right there. In fact, it is the 22nd, so it is that week, and that's why we're seeing that elevated implied volatility. So I'm going to go to that. I'm going to take advantage of this because I know that the price of the stock can move one way or the other. I also know that implied volatility is a little bit elevated, and if I were to take this all the way to expiration, that's going to be past the earnings announcement. So I'm going to use this as an earnings announcement play. I'm going to sell premium out to, again, about that one standard deviation range. So we're going to look at the chart. We're going to go out to July 25th. So that's going to put us right about here. And we're going to say that's 273, all right? 273 to the upside. If we go to the trade tab and we look at the implied move, that's at 223, or excuse me, that's at $23 up or down that far out. So that's about 240, 50, 60 to about 270. So again, that's about the same range, right? 270. So I'm going to go out to about the 275 or the 280 strike price. I'm going to go in this particular case to the 275 strike price. Let's just do the same thing that we've been doing. We're going to double check volume and open interest at the 275. I've got a lot of open interest at the 275 versus the 280, so that's going to influence my decision a little bit. I'm going to come back in a strike to the 275 rather than going out to the 280 simply because it's a more liquid market. Not necessarily tighter bid-ask spreads, but it's a more liquid market here, right? So I'm going to use that one as my expected range. That's where I'm going to look at selling this cover call. So I'm going to bring in my other option Greeks here. Delta is the 19-cent delta, 12 cents a theta. We're a little bit further out in time, so that theta is going to be a little bit slower. But implied volatility, if implied volatility goes down after the earnings announcement, that's going to definitely benefit this trade, right? So I'm going to look at selling this option. My goal here is to keep the stock, but I'm not going to sell against all of the shares of the stock. So in the event that something happens and I bring in a little bit of premium, I'm not losing my whole position in the underlying stock in this particular case. And again, remember, these are illustrative examples. So I'm going to go ahead and click on confirm and send. I'm going to read through this order, make sure that this is what I want to accomplish. Bringing in 263 against those shares. I'm only going to sell one contract here. We're going to put that in the cash secured puts and covered calls. That has a probability. Let's go ahead and click on send and fire that order off so that we can get it there. That's a probability of about 32% probability of touching that 275 strike, which again is about that one standard deviation range, right? Cool. So there we go. That's right. So why does the number of contracts in open interest influence the decision, right? So Karthik asks that question because it's a more liquid market. I'm more likely to be able to get easier fills than in a strike price that has 11 contracts because there's more activity there, right? Now, I could also buy a put. You're absolutely right. And create a collar trade here to protect that downside move. So that's something else to consider. And you notice what's happened in that 275 strike. Look at where that bid-ask spread went to just really quickly. I mean, that bid-ask spread, we're coming towards the end of the day and volatility is kind of jumping around. But notice what happened with that bid-ask spread pretty quickly. That's interesting. Now, that may be an anomaly here simply because of what's going on, but that's kind of an interesting development. That's, again, one of the other reasons why we don't oftentimes put stop orders on option trades, because you can get this wild mispricing because of disparities on the bid-ask spread and big widening of that bid-ask spread because of order flow. So that's one of the reasons why, because if I had a stop on this at the bid triggered by the bid price at 287, yeah, that could be a challenge. So it's interesting. This may be simply a mispricing. We'll see if that kind of comes back in line. But here's what we've done today, guys. Here's our GE trade. We put one contracting on against the long 500 shares at the 275 strike. We put on a FedEx cash secured put, which is already working in our favor here in this particular case. And we put on a Coinbase covered call for 4 days to go until expiration. That's kind of not working against us at the moment because the stock is still going up and not back down. So a couple of different ways to approach this, including using probability of touching one standard deviation in that expected move. My thanks to Brent Morris for helping me out today. My thanks to our great production staff for helping us out as well. Remember to click on subscribe and like today to this webcast and follow us on X. Brent put those X handles up in the top of the chat. Have a great day, everybody. We'll see you soon. Take care. Bye-bye.